What's up everyone, Jake here. Welcome back to another video in my Schwab 25K brokerage account challenge where I am swing trading and buying and selling options of S&P 500 companies to double my money. I will include the playlist down below if you haven't seen any of my other videos, and it's me versus that total stock market index fund. This video is current as of February 18th. This is trading day 32 of 252 for the year. And the stock market the last like 2 weeks has been pretty flat. It was as low as 3,700 by the end of January, and when it shot up to 39, everybody was thinking, man, it's going to hit 4,000 this week. And it can't seem to quite get up to 3,950, but it also doesn't want to go below 3,900. So the total stock market index fund is up 7.32% or $1.83 from its $25 starting position. And I am up $2,073.99 or 8.3%. So I am holding strong in front of that index fund. And these are my positions as of February 11th. If you want to pause the video, you can compare to what they changed to. And it has changed to this as of the market closing on February 18th. So let's just go over all the differences. First, I only exited one position, and this was Charles Schwab. My cost basis was $2,068. I sold for an $81 profit or 3.9%. I might have sold too soon. I think I bought once it was below the 50-day moving average. It then got up to here and started going sideways. So I was like, well, it's consolidating sideways, so I decided to get out. As soon as I got out, it shot up to 61. That's just how it is sometimes. So you gotta keep moving. So let's first talk about the put contracts that I sold on Synchrony Financial and Citizens Financial Group. I sold these a couple weeks ago, and they're about to expire. They're going to expire tomorrow. So let's review put contracts when you sell. You know you sold a put contract because it says P, and this is a -1. So I have an obligation to buy these stocks should the share price go below the strike price. So Synchrony is at $35.97, and the strike price is $35. Will it drop 97 cents during trading tomorrow? It might, but I don't think it will. Same thing with CFG. The strike price is $35 and the current share price is $40. There's no way it's going to drop $5 in one day. And even if it did, I would be happy to buy it at that price. So let's think about how this works. So when you look at my gain loss for these two put contracts, it says I'm up 98% on my cost basis, up 97%. The reason why is Friday is the last day for this contract to move to be in the money. So the market value of this contract is only $2.50. So I was paid by a buyer $154 a couple weeks ago. The contract is now only worth $2.50. That's the remaining extrinsic value. Same thing with CFG. A buyer of this contract weeks ago paid me $89. The contract is now only worth $2.50. So when these expire tomorrow out of the money, my cost basis will go up to a perfect 100. The contract is worthless. It expires out of the money. So the max profit I can make by selling put contracts is what I was paid by the buyer for the premium of the contracts. Next up is the covered call I sold on Xerox, and once again this expires tomorrow the 19th, so there's only one trading day left for the share price to move. So let's think about this. So the strike price is 23 and the current share price is 23.30. Can Xerox lose 30 cents worth of value tomorrow? I think it can. So it's possible that this contract will expire worthless out of the money and I won't lose my 100 shares. A covered call is when you own 100 shares and then you sell, you sell a call contract. So somebody out there bought it hoping the share price of Xerox would go up. So this cost basis of $38, that's what I was paid. I get to keep that money no matter what. Now, if Xerox finishes above $23, let's say it closes at $23.30, I am going to be paid 23 times 100, so $2,300. That money will go into my account and I will lose these 100 shares. Now the buyer of that call contract is happy because those shares that he bought for $23 a share, 100, they're worth $23.30. So if he wants to, or he or she wants to do a market order and immediately sell them, they can make a $30 profit. However, whoever bought that contract might have spent, $38 for that contract. So they're not above their break even. But I'm happy, if it doesn't expire in the money, I'll probably sell it as soon as this contract disappears. And if it expires in the money, once again, I'm happy to get rid of my 100 shares of Xerox for a profit. New position I took is Walmart, and I don't need to explain to you what Walmart is. And what happened with Walmart today is their earnings were reported and they missed the estimates or something. It showed a sales growth. However, their in-store sales still grew by 8.6%. And their e-commerce sales, they're trying to compete with Amazon, was up by 69%. So it's kind of like a good news, bad news, but it makes sense. Like, if more people are going on Walmart.com to buy their Walmart purchases, then it makes sense that they're not going to the store. Yes, Walmart wants to attract more people back who shop on Amazon, but they might just be trading one for the other. I'm not worried about Walmart's fundamentals. You look at this sell-off here. First of all, it's been consolidating around 145, 150 since last November. However, the massive sell-off today, it's almost down to its 200-day moving average. So I thought that was a no-brainer to jump into that. Go ahead and look at Walmart's stock performance, since they IPO'd, and this is a juggernaut. Market cap of $389 billion, so it's not a rapidly expanding company, but it offers a solid dividend now. It did increase its dividend. If you had invested in Walmart at $58 in 2015, you would have two and a half times your money in 5 years. That's pretty solid. Their PE is currently 21. Price to free cash flow is 22. You like seeing these below 20, but it's Walmart. I don't think this is a bad time to buy this stock. I don't see this not going up in the near future. Next stock I took a position in is CVS. I already swung in and out of Walgreens earlier this year. I still like Walgreens, and CVS is pretty much the same. I think people are going to be going to these stores repeatedly, trying to schedule their appointments to be vaccinated. Most of the vaccines require 2 trips to CVS or 2 trips to Walgreens. You gotta walk through the store and go to the back to get your shot. So I think it's going to be a good half year, good quarter, good year entirely for companies like Walgreens, Rite Aid, or CVS. So let's see what happened here. It's down from its high of about 76, and it got below the 20 and 50-day moving averages. So there was a big sell-off, once again, on earnings. Look at this. CV's earnings beat estimates, boosted by COVID testing and vaccination. So once again, kind of like my last video, these companies, it doesn't matter if their earnings report is good or bad, there's always a massive sell-off. There's somebody who had higher expectations, or they feel like they can close out this position now and jump to whatever's next. I don't get it. I don't know why large funds would do this, but look at this. Look at this red bar chart down here showing the massive sell-off. So I bought that same day. It then went up a little bit. It's back down today, but I still feel confident this can get back up to 75. For my next stock, this is potentially the best news that any swing trader or investor can have, and that is, hey, Warren Buffett just bought your stock. So Verizon climbs 4% after Warren Buffett reveals nearly a $9 billion investment. Now, Verizon, as of yesterday or the day before, only had a market cap of $220 billion. So Warren Buffett basically took close to a 4 or 5% position in Verizon. So I thought Verizon was undervalued. When you look at this stock chart, Verizon is a very stable dividend stock, and it hovers in this range. And as soon as it got below that 200-day moving average, I said, hey, this is a good time. For whatever reason, there was a massive sell-off here. It's been depressed, And this green bar right here is everybody finding out, hey, Warren Buffett just bought $9 billion worth of Verizon. So shot back up. I think there's huge upside for this stock now. I definitely want to see it above the 50 and the 100 and the 200. So once it gets above the 250 and 100, I think it's a good time to swing out of this stock and take my profit. And because Verizon shot up, AT&T also went up. It was back down today, but Verizon and AT&T were my negative losing positions, and they're now way up. And I got lucky because my last video I explained buying a call contract. I've sold calls and I've sold puts, but this is my first time in this challenge buying. We'll talk about that in a second. But I bought this call contract right before Warren Buffett said he was buying Verizon. That helped other communication stocks. So AT&T also saw a jump. I'm now playing this stock 3 different ways, and that's probably too much. And if your assumption is that a stock will go up, you can do 3 things. You can either buy the stock, you can buy a call option, or you can sell a put option. Right now on AT&T, I've done all 3. Now, in my opinion, if you have bought a call contract, you're reserving the right to buy that stock should it go up. So it doesn't make sense for me to hold it. I was going to sell it today, but then it was down 1%. So I'm going to wait until tomorrow or Monday and see if I can get back that 1%. I'm just being greedy here. Now, the call contract, let's go through it. But first, look at AT&T's stock chart. It's been consolidating, trading sideways since December. This is a very well-rested stock. And when you look at their share price pre-pandemic, it was trading for close to $40. AT&T over the last 5 years has been as high as 43. This is not a growth company, it's a dividend stock. Look at this, 7%. However, when it's cyclical and you can tell that it's gone down, there's usually an upswing. To go from this had to have been like $28 a share at the end of 2018 up to 39. I mean, that's some pretty nice growth for a 1-year period on a dividend stock. So let's break down and discuss buying a call option. And when you buy a call option, once again, you're going to see the C. And instead of a -1, because I've sold a covered call on Xerox, you're going to have a +1. So it's just going to say 1 because you bought to open this call contract. Now, the expiration date is June 18th. I chose something 4 months out. In my opinion, if you're buying calls, the sweet spot is that 2 to 4 month period. If this isn't turning me a profit by the time I get below 60 days, I want to get rid of it. When you buy contracts, you buy puts or you buy calls, theta decay is exponential. So it's really going to eat away at the value of this contract that last 30 days, and I don't even like the period between 30 and 60. I generally don't like buying contracts because, once again, the contract just becomes less valuable as you hold it over time. However, with AT&T, I bought this because I was pretty confident it's going to pop. I don't know when, though. So by buying this June 18th contract, I'm giving myself, in effect, 2 months according to my own rules. If this can go up in either February, March, or the beginning of April, I'm feeling pretty good about it. If we hit May and it has not gone above $30, then I would probably buy it back for a loss just to not lose everything. And once again, let's go through each line. So the strike price is $30, meaning that I've reserved $3,000 of buying power should I want to buy this stock. So once again, when you buy contracts, you don't actually have to exercise them. You can always sell to close a call or a put contract if you don't have the money. Like, let's pretend I didn't have the money in my account to buy the 100 shares at expiration. You can always sell the contract to somebody else for a profit, and you'll lose like $1 or $2 on the bid-ask spread, but that's that other person's profitability for handling your contract for you. So the premium that I paid money 2 days ago for this contract is $98.65. However, AT&T's share price went up, so it became more valuable in the last 2 days. It's now worth $108. You know this is how much it's worth because that's the last agreed upon price between a buyer and seller for this exact same contract. So I'm up 9.8% on my position, meaning I'm up 9% on my cost basis of $98. So what is my potential profit on this position? And when you buy calls, your potential profit is unlimited. If the stock just keeps going up, you've already reserved the right to buy that stock at $30. So let's pretend that this stock goes up to $40. What happens is I can then buy AT&T $4,000 worth of value on the New York Stock Exchange for $3,000 from this other person that sold me this covered call or this not covered call. Meaning my cost basis is my only expense. So the profit, if it went up to 40, let's say it went up to 40, then it'd be $1,000 minus $98. So I will have 9x'd or 10x'd my money. So if AT&T went up to $40, my gain loss percentage would be 900%. Is it going to go up to 40 in the next 2 months? I don't think so, but I think it'll get up to 33 or 34. If it gets up to 33 or 34, then this percentage right here will be 300%. A pretty good return on only a cost basis or a capital investment on my part of $98. So I'm definitely rooting for AT&T over the next 2 months. It could definitely get back to 35. It could go up to 40. I don't know if it gets some momentum or some good news. It could return to pre-pandemic levels. I don't know. I know at the beginning of this channel, I told you guys that I would not be buying calls or buying put options. I think I'm going to be bending on that rule. Now that I've explored buying call options more, you don't want to buy a call option on a stock that is just going up. The premium is usually too much to justify it in my opinion, and it can go terribly wrong. However, the stocks that I'm interested in are stocks like AT&T, things that have been trading sideways for months. They're very well rested, they're very well consolidated. These are stocks that I want to swing in with, but it's a waste of time to put $2 grand, $3 grand, $4 grand in there when I can just buy a call contract for $100, $200, $300. For me, it makes way more sense saying this stock is going to pop and it's going to go up at any time. I don't know when that will happen. I can't swing into it hoping it does it in the next couple days or next couple weeks. So buying call contracts that are 5 to 6 months out, it'll help me capture that value should stocks like AbbVie, AT&T, Verizon, Huntington Ingalls, if they just pop like they should based on their fundamentals. I don't know when the market is going to get momentum behind these well-rested stocks. So I like the idea of buying call options for those specifically. Last thing we should talk about is Costco, and Costco is down again today. So my position, 3% overall. It's not the end of the world, and when you just look at this stock chart, it just seems so obvious what is happening. So look at this nice round number of 350. I've switched to the candlestick chart dates so you can see the wicks. The wicks have reached 350 twice in the last 2 months, and then it's gone back up. People are not ready to start piling back into Costco because this 200-day moving average is slowly getting there. I think once this 200-day moving average hits 350, people are going to say, okay, it's time to uptrend Costco again until it looks overvalued and then it starts consolidating sideways again. So I'm watching this until it hits 350. As soon as this hits 350, I'm going to double my position in Costco, assuming that it's going to start uptrending again. So let's review my positions, and once again, Costco looking to double. Verizon, I mean, now that Warren Buffett's in it, I want that 10%. Let's get that money on Verizon. AT&T, 5%, why not? CVS looking for about 5%. Xerox, it's a coin flip whether or not I'm going to lose that tomorrow. If I don't lose it because of the covered call, I will just sell it, hopefully at 3 or 4% profit. Synchrony, it's down today, but once this is back above 5%, I will sell it. Johnson & Johnson, still waiting for that emergency approval of the vaccine, looking for 5 to 10%. Apple has been down a lot. I think it's almost down 10% from its high. So if my cost basis goes down by 5%, I'm considering doubling up this position from 2,000 to 4,000. I love Apple. Walmart looking for an easy 5%. Same thing with FMC and IPG. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, subscribe if you haven't already. If you have any comments or questions about anything I talked about today, I feel like it was a lot today. There's a lot going on. And yeah, until the next update video, wish me luck. Take care, guys.